Having an effective and efficient inventory management system is imperative. These systems ensure that customers always have enough of what they want and balance that goal against a retailer's financial need to maintain as little inventory as possible. In business, the term inventory is used to describe the goods that a company has in its possession at any given time. For companies engaged in manufacturing activities, inventories are divided into raw materials used to make other products, partially completed products, work in process, and finished goods ready for sale to the trade. Manufacturers sell their finished goods to wholesalers and retailers. These goods, purchased and held expressly for resale, are commonly known as merchandise inventory. For wholesalers and retailers, the primary source of revenue is from the sale of this merchandise. In terms of dollars, merchandise inventory is one of the largest and most important assets of a manufacturing company. As an expense, the cost of goods sold is the largest deduction from sales in the determination of a company's profit, often larger than the total of operating or overhead expenses. Interestingly, merchandise inventory is an account that's found both on the balance sheet and the income statement. The method used to determine the value of this inventory has significant impact on a company's bottom line results. In addition to appearing on financial statements, the value of the merchandise inventory must also be determined for income tax purposes and insurance, and as a business indicator to management. To place value on a merchandise inventory, we must first know the quantity and the cost of the goods remaining at the end of the operating period. Merchandise held for sale must be physically counted at least once a year. Many businesses take inventory on a quarterly or even monthly basis. This is known as periodic inventory system because the physical inventory is counted periodically. Today, most companies use computers to keep track of merchandise inventory on a continuous or perpetual basis. This is known as a perpetual inventory system. For each merchandise category, the purchases made by the company are added to the inventory, whereas the sales to customers are subtracted. These balances are known as the book inventory of the items held for sale. As accurate as the perpetual system may be, it must be confirmed with an actual physical count at least once a year. Taking inventory consists of physically counting, weighing, or measuring the items on hand, placing a price on each item, and multiplying the number of items by the price to determine total cost. The counting part of taking inventory, although tedious, is not difficult. The pricing part, however, is an important and often controversial business decision. To this day, accountants have varying opinions on the subject of inventory valuation techniques. The one method of pricing inventory that actually matches the flow of costs to the flow of goods is known as the specific identification method. This method is feasible only when a variety of merchandise is carried in stock and the volume of sales are relatively low, such as with automobiles and other expense items. In reality, most businesses have a wide variety of merchandise and find this method too expensive because implementation would require sophisticated computer barcoding systems. For this reason, it's customary to use an assumption as to the flow of costs of merchandise in and out of the business. The three most common cost flow assumptions or inventory pricing methods are known as follows. First in, first out, or FIFO, cost flow is in the order in which the costs are incurred. Last in, first out, or LIFO, cost flow is in reverse order in which the costs are incurred. An average cost where cost flow is an average of the cost incurred. Although cost is the primary basis for the valuation of inventory, when market prices or current replacement costs fall below the actual costs of the items in inventory, the company has incurred a loss. All the inventory valuation methods listed in this presentation are acceptable for both income tax reporting and a company's financial statements. For income tax reporting, once a method has been chosen, the Internal Revenue Service requires that it be used consistently from one year to the next. Any changes in the method used for inventory valuation must be for a good reason and must be approved by the IRS. The first in, first out FIFO method assumes that the items purchased first are the first items sold. The items in inventory at the end of the year are matched with the cost of the items of the same type that were most recently purchased. This method closely approximates the manner in which most businesses reduce their inventory, especially when the merchandise is perishable or subject to frequent style or model changes. Essentially, this method involves taking physical inventory at the end of the year or accounting period and assigning cost in reverse order in which the purchases were received. Here are the steps to pricing inventory using FIFO. Step 1. List the number of units on hand at the end of the year and their corresponding costs, starting with the ending balance and working backward through the incoming shipments. Step 2. Multiply the number of units by the corresponding cost per unit for each purchase. Step 3. Calculate the value of ending inventory by totaling the extensions from Step 2. The first in, first out FIFO method, illustrated here, assumes that items purchased first are the first items sold. The items in inventory at the end of the year are matched with the cost of the items of the same type that were most recently purchased. This method closely approximates the manner in which most businesses reduce their inventory, especially when the merchandise is perishable or subject to frequent style or model changes. Essentially, this method involves taking physical inventory at the end of the year or accounting period and assigning cost in reverse order in which purchases were received. To illustrate the application of the FIFO method of inventory pricing, we'll use the following annual inventory of data frames at Target. Here's our example. When physical inventory of the picture frames was taken at Target on December 31st, it was found that 700 remained in inventory. Using FIFO method of inventory pricing, what's the dollar value of the ending inventory? Step 1. Set up a table listing the 700 picture frames with costs in reverse order of acquisition. Step 2. Extend each purchase, multiplying the number of units by the cost per unit as you see here. Step 3. Find the total of the extensions. You'll see the math worked out in this table by units, cost per unit, and total cost. The last in, first out LIFO method assumes that the items purchased last are sold or removed from inventory first. The items in inventory at the end of the year are matched with the cost of the items of the same type that were purchased earliest. Therefore, items included in the ending inventory are considered to be from the beginning inventory plus those acquired first from purchases. This method involves taking physical inventory at the end of the year or accounting period and assigning cost in the same order in which the purchases were received. Here are the steps using LIFO. Step 1. List the number of units on hand at the end of the year and their corresponding costs, starting with the beginning inventory and working forward through the incoming shipments. Step 2. Multiply the number of units by the corresponding cost per unit for each purchase. Step 3. Calculate the value of ending inventory by totaling the extensions from Step 2. The last in, first out method, illustrated here, assumes that the items purchased last are sold or removed from inventory first. The items in inventory at the end of the year are matched with the cost of the items from the same type that were purchased earliest. Therefore, items included in the ending inventory are considered to be those from the beginning inventory plus those acquired first from purchases. This method involves taking physical inventory at the end of the year or accounting period and assigning cost to the same order in which the purchases were received. So here's an example of using LIFO. Suppose when physical inventory was taken on December 31st, 700 frames remained in inventory. Using the LIFO method of inventory pricing, what's the dollar value of this ending inventory? Step 1. Set up a table listing the 700 picture frames with costs in order that they were acquired, like you see here. Extend each purchase, multiplying the number of units by cost per unit, like you see here. And finally, we find the total of the extensions, as you see here. I always recommend using a table labeled in this way to help make those calculations easy. The average cost method, also known as the weighted average method, assumes that the cost of each unit of inventory is the average cost of all goods available for sale during that accounting period. It is a weighted average because it takes into consideration not only the cost per unit in each purchase, but also the number of units purchased at each cost. Here are the steps for pricing inventory using averages. Step 1. Calculate the average cost per unit by following this formula. Average cost per unit equals costs of goods available for sale over total units available for sale. Step 2. Calculate the value of ending inventory by multiplying the number of units in ending inventory by the average cost per unit, where ending inventory equals units in ending inventory times average cost per unit. When the market price or current replacement price of an inventory item declines below the actual price paid for the item, companies are permitted to use a method known as the lower of cost or market (LCM) rule. This method takes into account such market conditions as severely falling prices, changing fashions or styles, or obsolete inventory items. The use of the LCM rule assumes that decreases in replacement costs will be accompanied by appropriate decreases in selling prices. The lower of cost or market means comparing the market value, current replacement cost, of each item on hand with its cost, using the lower amount as its inventory value. Under ordinary circumstances, market value means the usual price paid based on the volume of merchandise normally ordered by the firm. Here are the steps to calculating inventory using LCM. Step 1. Calculate the cost of each item in the inventory by using one of the acceptable methods, FIFO, LIFO, or weighted average. Step 2. Determine the market price or current replacement cost for each item. Step 3. For each item, select the basis for valuation, cost or market, by choosing the lower figure. Step 4. Calculate the total amount of each inventory item by multiplying the number of items by the valuation price chosen in Step 3. Step 5. Calculate the total value of inventory by adding all figures in the amount column. Here's an example. The following data represent the inventory figures of Sundance Boutique. Use the lower of cost or market rule to calculate the extended amount for each item and the total value of the inventory. The following data represents the inventory figures of the boutique. In this example, the cost and market price are given. We begin by choosing the lower of the cost or market and then extending each item to the amount column. For example, the style number 44 blouse will be valued at the cost $27.50 because it's less than the market price of $31.25. The extension would be 40 times $27.50 equals $1,100. The retail method of inventory estimation is used by retail businesses of all types and sizes. To use this method, the company must have certain figures in its accounting records, including the following: the beginning inventory at cost price and at retail or selling price, purchases during the period at cost price and at retail, and net sales for the period. From these figures, the goods available for sale are determined at both cost and retail. When they calculate the ratio, it's known as the cost retail price ratio, or simply the cost ratio. By the formula, cost ratio equals goods available for sale at cost over goods available for sale at retail. This ratio represents the cost of each dollar of retail sales. For example, if the cost ratio for a company is 0.6 or 60%, this means that 60 cents is the cost of each dollar of retail sales. Here are the steps in estimating inventory using retail. Step 1. List the beginning inventory and purchases at both cost and retail. Step 2. Add the purchases to beginning inventory to determine goods available for sale at both cost and retail, where beginning inventory plus purchases equals goods available for sale. Step 3. Calculate the cost ratio. Step 4. Subtract net sales from goods available for sale at retail to get ending inventory at retail. Step 5. Convert ending inventory at retail to ending inventory at cost by multiplying the ending inventory at retail by the cost ratio, where ending inventory at cost equals ending inventory at retail times cost ratio. Here's an example of estimating inventory using retail. Using the retail method, estimate the value of ending inventory at cost on June 30th from the following information for Dependable Distributors Incorporated. Using the retail method, estimate the value of ending inventory at cost on June 30th like we just talked about using this information. Step 1 and 2. List the beginning inventory and purchases and calculate the goods available for sale. Step 3. Calculate the cost ratio, where 350,000 over 700,000 equals 0.5 or 50%. Step 4. Find ending inventory at retail, where ending inventory at retail equals 700,000 minus 500,000 to equal $200,000. Step 5. Finally, convert the inventory at retail to inventory at cost by using the cost ratio, where ending inventory at cost equals 200,000 times 0.5 or $100,000 in ending inventory at cost. The gross profit or gross margin method uses a company's gross margin percent to estimate the ending inventory. This method assumes that a company maintains approximately the same gross margin from year to year. Inventories estimated in this manner are frequently used for interim reports and insurance claims. However, this method is not acceptable for inventory valuation on a company's annual financial statements. Remember that net sales comprises the cost of goods sold and gross margin, where net sales 100% equals cost of goods sold plus gross margin. From this equation, we see that the gross margin percent is known. The cost of goods sold percent would be its complement because together they equal net sales, which is 100%. So cost of goods sold equals 100% minus gross margin percent. Knowing the cost of goods sold percent is the key to this calculation. We use this percent to find the cost of goods sold, which when subtracted from goods available for sale gives us the estimated ending inventory. Here are the steps to estimating inventory using profit. Step 1. Calculate the goods available for sale, where goods available for sale equals beginning inventory plus net purchases. Step 2. Find the estimated cost of goods sold by multiplying net sales by the cost of goods sold percent, where estimated cost of goods sold equals net sales times 100 minus gross margin percent. Step 3. Calculate the estimate of ending inventory by subtracting the estimated cost of goods sold from the goods available for sale. Here's an example. Anglers Fishing Supply Incorporated has gross margin of 45% on all of its wholesale supplies. In April, Anglers had a beginning inventory of $80,000, net purchases of $320,000, and net sales of $500,000. Use the gross profit method to estimate Anglers' cost of ending inventory. Step 1. Calculate the goods available for sale, which is equal to $80,000 plus $320,000 to total $400,000. Step 2. Find the estimated cost of goods sold, where the estimated cost of goods sold equals $500,000 times 100 minus 45%, which is 55% multiplied by $500,000, which equals $275,000. Finally, calculate the estimate of ending inventory, equaling $400,000 minus $275,000 for a total estimated ending inventory of $125,000. When calculating inventory turnover, the procedure always involves dividing a measure of sales volume by a measure of average inventory. This average inventory is commonly found by adding the beginning and ending inventories of the operating period and dividing by 2 like you see here. When inventory turnover rate is calculated at retail, the measure of sales volume used is net sales. The average inventory is expressed in retail sales dollars by using the beginning and ending inventories at retail. The inventory turnover rate is expressed in number of times the inventory was sold out during the period. Here are the steps to calculating inventory turnover rate at retail. Step 1. Calculate the average inventory at retail, where average inventory equals beginning inventory plus ending inventory divided by 2. Step 2. Calculate the inventory turnover at retail, where inventory turnover equals net sales over average inventory at retail. Here's an example. Hobbytown had net sales of $650,900 for the year. If the beginning inventory at retail was $143,000 and the ending inventory at retail was $232,100, what is the average inventory at retail and the inventory turnover at retail rounded to the nearest tenth? Step 1. Calculate the average inventory at retail, which is equal to $143,000 plus $232,100 divided by 2, which equals $375,100 divided by 2, or an average inventory of $187,550. Step 2. Calculate the inventory turnover at retail, which is equal to $650,900 divided by $187,550, which equals 3.47 or 3.5 times average inventory. When calculating inventory turnover, the procedure always involves dividing a measure of sales volume by a measure of average inventory. This average inventory is commonly found by adding the beginning and ending inventories of the operating period and dividing by 2, like you see here. Frequently, the inventory turnover rate of a company is expressed in terms of cost dollars rather than selling price or retail dollars. When this is the case, the cost of goods sold is used as the measure of sales volume and becomes the numerator in the formula. The denominator, average inventory, is calculated at cost. Here are the steps. Step 1. Calculate the average inventory at cost, where average inventory equals beginning inventory plus ending inventory divided by 2. Step 2. Calculate the inventory turnover at cost, which equals the cost of goods sold over the average inventory at cost. Here's an example. Metro Mechanical Incorporated had cost of goods sold of $416,200 for the year. If the beginning inventory at cost was $95,790 and the ending inventory at cost was $197,100, find the average inventory at cost at the inventory turnover at cost rounded to the nearest tenth. Step 1. Calculate the average inventory at cost, which equals $95,790 plus $197,100 over 2, which gives us an average inventory of $292,890 over 2, which equals $146,445. Step 2. Calculate the inventory turnover rate at cost, which is equal to $416,200 over $146,445, which equals 2.84 or 2.8 times. Trade associations and the federal government publish a wide variety of important industry statistics, ratios, and standards for every size company. When such inventory turnover figures are available, merchandise managers can use the following formulas to calculate the target average inventory required by their firm to achieve the published industry standards for a company with similar sales volume. Here are some formulas. For target average inventory at cost is equal to cost of goods sold over published inventory turnover at cost, where target average inventory at retail equals net sales over published inventory turnover at retail. Here's an example. F-Stop Photo Incorporated, a wholesale photo supply business, had cost of goods sold of $950,000 for the year. The beginning inventory at cost was $245,000, and the ending inventory at cost amounted to $285,000. According to business research firm, the inventory turnover rate at cost for a photo business of that size is 5 times. Calculate the average inventory and actual inventory turnover. Step 1. Calculate the average inventory at cost, which is equal to $245,000 plus $280,000 over 2. That gives us an average inventory of $265,000. Step 2. Calculate inventory turnover at cost, which is equal to $950 over $265,000, which is equal to 3.58 or 3.6 times. Step 3. Calculate the target average inventory, which is equal to $950,000 divided by 5, which equals $190,000.